Okay. In this chapter, I'm going to talk about investment banks, where the money is to be made. And private equity. So, these would be things like, as we probably have, most of you probably heard of banks like Goldman Sachs, the now non-existent Lehman Brothers. These are not commercial banks, meaning that they basically collect assets and then invest those assets strategically to make more money for the bank itself as well as clients of the firm. These investment banks become the one-stop shop. A one-stop shop, if a company says, I want to go public, meaning I want to issue shares for the first time, they would approach this investment bank, and the investment bank would, for a fee, line up the investors and set up the initial offering of the company, and even buy shares if not enough people are buying the shares themselves, and then they would hold them until later. Investment banks also would buy the US treasuries if others are not buying them. Some of my research right now is on one of the earliest investment banks. Some would say the first investment bank in the United States, which actually bought Civil War bonds to fund the Union in the war against the Confederate States. Advice is offered as well, but advice is not going to be free. So you'd have to pay these investment banks quite a bit to get advice about what to do. Yeah. So at the end of the day, basically what they do is they market, sell, and distribute equities and bonds and other kinds of things. They help establish what the price should be when it's offered as a stock. They help determine what the interest rate should be for certain bonds that are offered. They go and they get the rating for the bond from the bond rating agencies that we already talked about in the previous chapter. They can basically help assess the risk, and then they can line up the investors. Again, all things that are incredibly useful if you're going to be raising money in the bond market or the equity markets if you're a company. But again, you're going to pay a lot for that as well, for that kind of service. Not only do these investment banks line up the investors, but they also engage in some trading on their own, proprietary trading. That's usually what gets these investment banks, that's usually what brings their downfall. It certainly did for Lehman Brothers, which decided to buy a lot of the credit default swaps. AIG and Lehman Brothers were both extensively involved in these things, and it brought Lehman Brothers, the investment bank, down because it engaged in that proprietary trading for their own interests. Then Goldman Sachs. So really, as the 21st century started, we had 5 big banks: Merrill, Morgan, Goldman, Lehman, and Bear Stearns. And basically, the 2008-2009 crisis, certainly got rid of Lehman Brothers. And then when you look at like Bear Stearns and Merrill Lynch, Bear Stearns combines with Bank of America, and Merrill Lynch with Citi. So then you start to get these mergers of investment banks with investment banks with the commercial lending institutions. Some would say causes even more problems, but in the 2008-2009 crisis, you're just trying to survive. These investment banks are engaged, they can own stakes in companies, and this is not public, meaning that you and I cannot buy the shares. Um, these are used, for instance, if a company says it wants to go private, it would have to buy all the shares that were already issued. It would do that through an investment bank. That would be one way that it could do that it could raise that money. And then what the investment bank will do is it will then spiffy up the company and then sell it and then reissue the shares again and get even more money. Private equity is incredibly risky. I probably would not get involved in it. You have to be a qualified investor, just like we were talking about with the hedge funds. To be a qualified investor, you have to have certain income and wealth levels and basic experience. You're not going to see in private equity, you're not going to see, that's not where you and I would do our investing. This is for large organizations. I know the Hawaii State Employee Retirement System, the ERS, the thing that funds my public pension. I know they're involved in things like this, but again, they're dealing with billions of dollars, not thousands or hundreds of even thousands of dollars. And then you've got LPs, limited partnerships. I actually own this. Not really by choice, but I have the problem with a limited partnership is it takes a lot of there's a fair amount of risk involved, and the problem is that you are in a partnership with other owners, but you don't have that much stake over the day-to-day management of the thing. So it's like you get to own it, but you don't get to make any decisions, and so you can get frustrated from time to time. In my wife's business again of finance, the firms, if you're with a firm long enough, you can become a limited partner, and then you have to front up a huge chunk of cash to then be a limited partner owner. Again, it's not. Yes, you can make money off of it. It's not like it's a charity, but it's also there's a great deal of frustration involved if you don't agree with all the decisions being made. And in other kinds of limited partnerships, anyone can set up a limited partnership, but basically there are limited partners and there are general partners that are above the limited partners. The general partners do get to make more decisions and they have larger stakes of money involved. And again, it's kind of like the owners, the ones that are providing the capital for the firm versus the ones that are making the decisions for the firm are different individuals. And that's really what's involved in these limited partnerships. Limited partners actually, there's not actually a lot of taxes being paid. And I would say just based on my own experience that it's true. You do have to file a Schedule K, and it becomes more complicated to do your taxes, but I don't think that the tax liability goes up significantly from it. And again, you can't, when you want to get out of the limited partnership, you can get your money back, but you're not going to be issuing, you're not selling shares. There's no shares or anything like that that you're actually selling. Then you've got this difference between dumb money and smart money. Dumb money means you're just giving the money, you're providing the money and you're getting your return. Smart money is so much more important. So you see this distinction if you ever watch episodes of like Shark Tank, which is like, they play it on repeat on Sundays on CNBC. The sharks are the smart money. They provide, like that one bald guy and that one guy that owns the Mavs. They all like provide money, but they also provide mentorship and advice and connections, and they want that business to succeed. And they're going to invest the time to do that, which is something they often talk about is what's the value of my time to investing in this company. Dumb money means you provide the money and you just, cross your fingers that they've got enough skills and knowledge to make it a go. And then finally, you've got what I think actually there's a great deal of this out there, unfortunately, is vulture capitalism. A lot of incredibly good companies have been destroyed by private equity firms buying out all the shares of a company, taking it private, loading up that company with debt, and then making it public again. Stores like J. Crew, Neiman Marcus, Sears, J.C. Penney, Radio Shack, and even GameStop. All companies that private equity firms bought out all the shares, so took it private, loaded it up with debt, and then reissued the shares. And then the new shareholders got stuck with this debt-laden company that then couldn't make its interest payments, and then the company goes bankrupt. Like Sears, like J.C. Penney. Oh, Toys R Us, forgot about that one. Who didn't like Toys R Us? This is just sad. I don't really, it frustrates me because it's just greed. It's not exactly what we want. Yes, capitalists are greedy, but it doesn't have to be that way if we as a society don't want it to be. I guess that's a nice way to end a chapters with a little bit of social commentary. You don't have to agree with me. I don't care if you do.